Maya is 22. She split a $140 skincare order into 4 payments of $35 using her debit card because the checkout page said no credit check, no interest. 2 weeks later, payment 2 came out on a Tuesday morning before her paycheck landed. Her bank charged her a $35 overdraft fee to cover a $35 payment. She didn't miss a payment. She didn't overspend on purpose. She got charged more in fees than the actual purchase because of a detail almost nobody explains. When Buy Now, Pay Later is linked to a debit card instead of a credit card, none of the protections you think apply to credit actually apply to you. Here's the part that makes this worth 25 minutes of your time instead of a 60-second tip. This isn't one app doing one shady thing. It's an entire legal category, an estimated hundreds of millions of transactions a year sitting in a gap between 2 sets of rules, and almost nobody using these apps knows which set of rules actually protects them. By the end of this video, you'll know exactly how the loophole works, how it compares to the credit products you already understand, which specific providers behave differently from each other, why regulators in other countries have already closed this gap while the US hasn't, and the exact checklist to protect yourself the next time you see split into 4 payments at checkout.
Let's start with the mechanics, because most explainers skip straight to opinions without ever explaining how the product actually works. Buy Now, Pay Later, BNPL, lets you split a purchase into several equal payments, usually 4, spaced 2 weeks apart, with 0 interest if you pay on time. Companies like Klarna, Afterpay, and Affirm built entire businesses on this model. Here's how they make money, even while advertising 0 interest. They take a cut from the merchant, usually around 4 to 6% of the transaction, in exchange for guaranteeing the merchant gets paid in full immediately. The merchant is happy because you spend more when checkout feels smaller. The BNPL company is happy because they collected a merchant fee up front and now get to collect your installments too. And you're happy because $140 feels a lot easier to say yes to when it's presented as 4 payments of $35. None of that is inherently a scam. Structured correctly and paid on time, BNPL genuinely does cost you nothing extra. The problem isn't the concept. The problem is one specific detail buried in how you fund it.
Here's the part almost nobody breaks down clearly, and it's the actual point of this video. In the US, credit cards are governed by strong federal protections, the Truth in Lending Act and the Credit Card Act of 2009 specifically. These laws cap certain fees, require clear disclosure of terms, limit how issuers can raise your rate, and give you dispute rights if something goes wrong with a purchase. When you use a credit card, even for something risky, you're wrapped in a specific legal safety net built over decades in response to real consumer harm. Debit cards are a completely different legal category. They're governed mostly by Regulation E, which focuses on electronic fund transfers, a framework built for things like ATM withdrawals and direct deposits, not consumer credit protection. When your BNPL payment is linked to a debit card, the money is being pulled directly from your checking account balance, the same as any other debit transaction. There's no card issuer standing between you and the withdrawal, absorbing risk or offering a formal dispute process the way a credit card company would. If the payment date hits and your balance is short, your bank doesn't decline it and protect you the way a responsible lender might. Depending on your bank's settings, it either bounces the payment and charges you a fee for that, or it covers the gap and charges you an overdraft fee for that instead. Either way, you're the one absorbing the risk that used to sit with the lender. And here's the number that should stop you. Close to 90% of BNPL purchases are being made this way, funded by debit, not credit. This isn't a rare edge case. It's the dominant way most people are actually using these apps, which means most people using BNPL right now are operating with almost none of the protections they'd assume come standard with buying on credit. To really understand where BNPL sits, it helps to place it next to the 2 things people usually compare it to, because both comparisons are half right and half wrong. Compared to a credit card, BNPL looks safer on the surface. No interest, no long revolving balance, a fixed short payoff schedule. All true. But a credit card used through the actual credit card network comes wrapped in the legal protections we just covered: dispute rights, fraud liability caps, and a card issuer absorbing risk instead of your checking account. A debit-funded BNPL plan gives up nearly all of that in exchange for the no-interest label. You're not comparing a safer product to a riskier one. You're comparing 2 different risk categories that happen to look similar at checkout. Compared to a payday loan, BNPL looks nothing alike, and in most ways that's true too. Payday loans typically carry extreme effective interest rates and target people already in financial distress. BNPL doesn't charge interest if you pay on time, and it's marketed to people who aren't necessarily in a credit crisis at all. But there's one uncomfortable structural similarity worth naming. Both products are built around short, fixed repayment windows, funded directly from your bank account or paycheck cycle, with real consequences if your income timing doesn't line up with the payment date. Payday loans are far more damaging on average, but the underlying mechanism of a fixed date pull against money you may not have yet is the same shape, just with dramatically different fee structures around it. The honest conclusion? BNPL isn't secretly a payday loan, and it isn't secretly just a credit card. It's its own category, built specifically to sit in the gap between the protections of one and the danger profile of the other, which is exactly why it needed the two comparisons to actually understand where it sits.
You might be wondering how this is allowed. The honest answer? BNPL grew faster than the regulatory system built to police it. Consumer credit law was largely written for a world of credit cards and installment loans issued by banks. BNPL companies structured their product specifically to avoid being classified the same way. Technically, many of these plans aren't credit in the legal sense the old laws were written around, because there's often no interest charged and no formal credit agreement in the traditional sense. That structural choice isn't necessarily malicious on its own, but it does mean an entire product category scaled to tens of millions of users before the rules caught up to define clearly what protection should apply. Regulators have started to respond. There's been movement toward requiring clearer disclosures and treating larger BNPL providers more like traditional lenders for oversight purposes. But regulation moves slowly, and enforcement is inconsistent between providers. Some voluntarily offer more consumer protection than they're legally required to, others do the bare minimum. Right now, in practice, you cannot assume any specific protection exists just because a company looks trustworthy or has a slick app. You have to check.
It's worth zooming out past the US for a second because it makes the regulatory gap easier to see clearly. Several other countries moved faster to bring BNPL under existing consumer credit rules. The general pattern elsewhere has been to formally classify BNPL products as regulated credit once they pass a certain size or usage threshold, which then triggers mandatory affordability checks before approval, standardized disclosure requirements, and dispute rights closer to what credit cards already provide. That doesn't make BNPL risk-free in those markets either, but it closes much of the specific gap this video is about, the part where a debit-funded plan quietly operates with almost no consumer protection framework around it at all. The US has been slower to formally reclassify BNPL this way, which is part of why this loophole has been able to persist at this scale for as long as it has. This isn't a political statement about which approach is right, it's just useful context. The loophole this video is describing isn't an unsolvable structural inevitability of the product, it's a specific regulatory choice, and other markets have already shown a different choice is possible. This next part matters because it's not accidental. BNPL adoption skews heavily toward younger consumers, people in their late teens through 20s, often with thinner credit history, sometimes with no credit card at all. That's not incidental to the business model, it's central to it. Someone with an established credit card and a strong credit history has other options and more built-in protection already. Someone without a credit card yet, a college student, someone early in their career, someone who's been told credit cards are dangerous and should be avoided, is the ideal customer for a product that says, you don't need credit for this. The marketing reinforces this directly. BNPL options show up heavily at checkout on platforms that skew toward younger shoppers. Fast fashion, beauty products, sneakers, concert tickets, placed as the default highlighted payment option, not just one choice among several. The checkout design itself nudges you towards splitting the payment because a smaller number at each step reduces the psychological friction that normally makes you pause before spending. This isn't a conspiracy theory. It's standard, well-documented behavioral design, used deliberately because it measurably increases both purchase frequency and average order size. None of this means BNPL is targeting you maliciously as an individual. It means the entire system is optimized around a demographic that's less likely to already have the financial literacy or protections that would make them push back. And if that's you, it's worth knowing you're the target market, not an accident.
One more piece almost nobody explains. The major BNPL providers don't all behave the same way, and treating them as interchangeable is part of what makes this confusing. Some providers offer a direct debit card linked Pay in 4 as the default fastest checkout option, with credit card funding available but not emphasized. Others push customers more explicitly toward a branded card product or a linked banking app of their own, which changes the fee structure and how disputes are handled entirely. Late fee policies also differ meaningfully between providers. Some cap the total late fees you can accrue on a single plan, others don't cap it the same way, and the difference between those two policies can matter a lot if you ever do miss a payment. Credit bureau reporting is the clearest example of this fragmentation. Historically, most BNPL providers didn't report your payment activity to the major credit bureaus at all, which meant paying on time didn't help your credit, but missing payments also frequently didn't directly hurt it, at least not immediately. That shifted unevenly.
Some major providers have started reporting to credit bureaus, others still don't, and the ones that do often only report certain plan types or only report negative activity like missed payments while staying silent on on-time payments. Practically, this means you cannot assume BNPL either helps or hurts your credit consistently. It depends entirely on which specific provider and plan type you're using, and that information isn't always front and center when you sign up. The takeaway isn't avoid provider X, use provider Y. Policies change too often for that kind of advice to stay accurate for long. The takeaway is read your specific provider's current terms on funding defaults, late fee caps, and credit reporting before you assume anything, because the answer is genuinely different depending on which app is open on your phone.
Let's make this concrete with 4 composite patterns, not one dramatic worst case, but the most common ways this quietly costs people money. Pattern 1, the overdraft stack. This is Maya's situation. A single missed by hours payment doesn't just cost you a late fee from the BNPL provider, it can trigger a separate overdraft fee from your bank on the same transaction. Some people using multiple BNPL plans at once have had 2 or 3 payments hit the same low balance week, stacking 2 or 3 overdraft fees from a single bad week of timing. The BNPL late fee might be $5 or $10. The bank's overdraft fee is frequently $35 per occurrence. The math gets ugly fast, and none of it shows up anywhere as debt. It just quietly drains your checking account. Pattern 2, invisible stacking across multiple apps. Because BNPL plans often aren't reported to credit bureaus the way traditional loans are, nothing stops someone from opening 4 or 5 separate BNPL plans across different apps at the same time. There's no unified system checking whether you already have $600 in pending BNPL obligations before a new app approves you for another $200 plan. You can end up with a real, meaningful monthly obligation that doesn't show up on any single statement, doesn't show up on your credit report, and isn't visible to you unless you're personally tracking every app separately. Pattern 3, the return-refund mismatch. When you return a BNPL-funded purchase, the refund process is frequently slower and messier than a normal debit refund because the money has to be reconciled between the merchant, the BNPL provider, and your bank. In the meantime, scheduled installment payments can still process on the original schedule, even though you've already returned the item and are waiting on your refund, meaning you can be out the money twice, temporarily, on a purchase you don't even have anymore. Pattern 4, the closed account gap. If your debit card gets replaced, lost, stolen, expired, or you simply switch banks, and you forget to update the payment method on an active BNPL plan, the payment attempt can fail silently, generating a missed payment mark and a late fee for something that was never really a decision to skip payment. This one catches people specifically because it doesn't feel like a spending mistake at all. It feels like an unrelated administrative hiccup, right up until it shows up as a fee, or, depending on the provider, a mark against you. None of these 4 patterns require you to be irresponsible. They require you to not know the mechanics, which, until this video, is exactly the position most people are in.
This video isn't telling you BNPL is evil and you should never use it. It's telling you the specific mechanics you need to control if you do. Here's the practical checklist. Fund it with a credit card, not a debit card whenever the option exists. This single choice restores most of the legal protections this entire video has been about: dispute rights, fraud protections, and a buffer between a missed payment and your actual bank balance. Yes, this means you need to already have a credit card in reasonably good standing, which not everyone does yet. But if you do have one, this is the highest leverage change you can make. Never run more than one active BNPL plan at a time. Since nothing automatically tracks your total exposure across apps, you have to be the system that tracks it. One active plan at a time means you always know your full obligation without needing to check 4 different apps. Calendar every payment date the moment you sign up, not when it's due. The overdraft trap specifically happens because payments land unexpectedly against a balance you weren't tracking. A 2-minute calendar entry at checkout eliminates almost the entire risk of pattern 1. Check whether your specific provider reports to credit bureaus before you assume anything about your score. This information is usually in the provider's terms, not advertised on the checkout screen. Look it up once per provider you use, and don't assume it's the same across apps. Update your payment method the same day you replace or cancel a card. This closes the gap from pattern 4 directly. Treat active BNPL plans the same way you treat any other subscription that needs manual updating. Read the late fee cap policy before your first missed payment, not after. Knowing in advance whether a provider caps total late fees on a plan tells you how bad a genuine worst case actually looks, instead of finding out under stress. Treat no interest as true only if you're certain you'll pay on time, not as a reason the purchase is automatically a good decision. Zero interest doesn't mean zero cost if it enables you to spend on things you'd have talked yourself out of buying if the full price hit you at once. That's not a legal risk, that's a psychology of money risk, and it's just as real.
Zoom out for a second.
BNPL isn't really a story about one shady product, it's a preview of something bigger happening across financial products aimed at younger consumers. New categories of spending and borrowing tools getting built and scaled faster than the regulatory system can classify and protect against them. Prediction markets, embedded lending inside shopping apps, subscription-based credit products, this pattern is going to keep repeating. The specific mechanics will change, but the underlying lesson from this video will still apply every time. Don't assume a new financial product comes with the same protections as the older category it resembles. Read the actual mechanism. Ask which legal framework governs it, not just what it's called. That single habit, checking the mechanism instead of the marketing, is worth more than memorizing any specific rule about any specific app, because the apps will keep changing and the mechanism-first habit won't.
So here's the actual takeaway. Buy now, pay later isn't a scam, and it isn't inherently dangerous, but it's being funded by debit cards in the overwhelming majority of cases. And that single funding choice quietly strips away almost every protection people assume comes with buying on credit. It's not identical to a credit card, and it's not secretly a payday loan. It's its own category, built in a regulatory gap that other countries have already started closing, while the US lags behind. The people most likely to get hurt by this aren't reckless spenders. They're exactly the people the product was designed to reach. Younger, thinner credit history, trusting that a clean-looking app wouldn't let something bad happen by accident. It can. Not because anyone's out to get you specifically, but because the legal category this product sits in was never built with the same guardrails, and nobody's going to tell you that at checkout. If this actually changed how you're going to use these apps, that's the whole point of this video. Drop a comment with which BNPL app you use most, and I'll tell you what I know about that specific provider's reporting and protection policies. If you've been hit with a fee like Maya's, share it in the comments too. It helps other people see this isn't rare. Subscribe if you want more of these deep, practical breakdowns instead of surface-level tips, and I'll see you in the next one.